Welcome to our workshop today on making budgets work. Many Americans struggle with budgeting and saving, and experts often tell us that the trick is to simply follow rules of thumb, like living within our means. But most people find that a lot harder to do than it sounds. So budgeting does not come naturally to everybody. It is a skill, and planning and preparation are required if you are to reach your savings goals. So in this workshop today, we'll discuss how to create and stick to a budget so that the practice starts to seem like second nature. But first, let's talk about why budgeting is important. There are many great reasons to budget. Did you know that daily budgeting is known to have a positive effect on nearly all aspects of your personal financial situation? Being aware of your current financial situation can make bill paying easier, and budgeting helps you pay down your debts so that you can pay them off. And when you budget, you can better meet your short-term and long-term savings goals. And creating a budget enables you to save for emergencies. Another factor that people might not consider is that budgeting can have a positive effect on your emotional well-being. Did you know that over half of all U.S. households regularly worry about finances? Creating a budget and then sticking to it may help to reduce stress and improve your general well-being. With financial security comes more freedom to enjoy your life. Despite the benefits, though, many Americans are struggling to create and maintain a budget. It doesn't matter who you are or what your education is, or what you do for a living, budgeting can be a struggle for us all. So let me ask you a few questions. And feel free to comment in the chat section if you'd like, or just think about these to yourself. How many of you have to be organized in your jobs, such as keeping track of resources or documents? How many of you have to create financial plans or budgets for your department? And how many of you have to keep track of spending? Now, how many of you feel as though you're much better at completing those tasks in your workplace than in your personal lives? Well, you are not alone. Some of the duties that we're required to perform at work, we struggle with at home. Some of the very skills we're hired for, we hesitate to use in our own lives. So why do you think that is? Well, there are many reasons why people don't budget, and you may have already thought of some. Here are some common excuses as to why people don't budget. So let's see if some of them apply to you. It's too much of a hassle or too time consuming. I don't have enough time to track my expenses and analyze my budget. My income and spending aren't consistent, so it feels impossible to create a budget that I can stick to. It's too complicated. Some aspects of personal finance seem like they take a degree or at least some training to understand. I have a really hard time sticking to a budget. If I buy something, I don't want to have to say no. I earned that money and I should get to enjoy it. When it comes to budgeting and analyzing my spending, I get a mental block. I hate thinking about my finances. It causes me stress and makes me depressed. Did any of those sound familiar? Well, there are also some deeper psychological issues that go on when people start to think about their finances. In fact, these have been identified by behavioral economists: present bias and status quo bias. Present bias means that the human brain is wired to focus on the short term. This probably goes back to our prehistoric roots when we had to focus on our day-to-day needs just to survive. For this reason, people are more inclined to think about their current needs and wants rather than plan for the future. Status quo bias means that people are much more likely to continue doing what they usually do rather than make any changes, even if the changes are obviously beneficial. Understanding the mental or emotional blocks that prevent us from breaking a bad habit may help us to overcome them. So before we go any deeper, let's do a quick self-reflection to learn about our own challenges when it comes to budgeting. So if you have the participant guide handy, please turn to page 3. Take a minute to think about what's prevented you from creating or sticking to a budget in the past, or obstacles that may arise when you go home and start to apply what you've learned here today. Then consider the creative ways that you can address those obstacles. Let me give you an example. One example that people often identify is time. One solution could be to assign a specific day each month to go through your finances. Mark it on your calendar and prepare for it by making sure to avoid any distractions. Or maybe working on your finances causes you stress. You could counter that by doing something relaxing beforehand, such as meditating or taking a walk. Try your best to think about possible solutions now. But remember, you'll be learning some tips later on in the webinar that can help, that you can apply to your obstacles. If you have any obstacles or challenges that come to mind right now, go ahead and write them down. Otherwise, I encourage you to come back after the webinar and take some time to continue this process. And don't forget, you can still download or print the participant guide by going to our website, myncu.com/webclass. So now that we've reflected on the obstacles and challenges that have prevented us from creating and sticking to a budget, let's get into why we're all here. You all want to get better at budgeting, but your motivations may differ. Creating a budget serves many purposes, and we've talked about how it can help us manage our day-to-day finances, pay off our debts, and minimize our stress. It also helps us to reach our financial goals. In fact, many people start to get serious about budgeting when they have a specific savings goal in mind. In this section, we'll discuss the different types of financial goals, determine what your personal goals are, and begin to create a plan to achieve them. Your financial goals can be separated into 3 types: short-term, mid-term, and long-term goals. Short-term goals can be accomplished in a short period of time, usually from a few months to 3 years. Examples of this are paying off a credit card debt or saving for a regular vacation, not necessarily jet setting across Europe for a few months. Long-term goals take longer to accomplish, like over 10 years, and are usually much larger in scope. Examples would be building a college savings fund, or the biggest long-term goal out there, saving for retirement. Medium-term goals fall somewhere in the middle, more than a normal vacation, but not as much as full college tuition. Some examples would be saving for a down payment on a home or buying a new car. The longer the term of the goal, the harder it is to accomplish. Remember, human brains are wired to think about immediate needs. Something that will happen in the near future, like a vacation, or something that you may need soon, like a home repair, is easier to save for than something that won't affect us for many years, like retirement. So in your participant guide on page 3, find the section titled Setting Your Goals. For this activity, think about your personal goals, how much you need to save to achieve each goal, and how much time you have to build the savings. For instance, maybe you want to take a cross-country road trip next summer. Determine how much money you'll need for that vacation and how many months you have to save that amount. Try to think of at least 3 goals in addition to building emergency savings, and we'll work on this goal a little bit later on in the course. So take a moment to think about this and maybe write down some ideas, but again, I encourage you to come back to this when you have some more time. So now that you've thought about your savings goal and considered any obstacles to achieving them, we can start to dig in, discussing how to budget effectively. And the first step is getting organized. Keeping your financial documents and information organized and maintained is an important part of your financial health. You need this information to create a budget, and keeping it organized will help you manage your finances more quickly in the future. The financial documents you'll need to create your budget are listed in your participant guide on pages 4 through 6. under the section Organizing Your Financial Documents. So let's go through each one of those together. Again, I understand that you may not have this information available to you at the moment, and that's perfectly fine. So just write down some notes as we go and then come back and revisit this when your documents are accessible. So first, you'll need a complete list of all of your net income, and that's the amount you take home. So the amount of your paycheck after taxes and other deductions. If you're self-employed or work odd jobs, this is your adjusted income after quarterly self-employment taxes are taken out. Remember, wages may not be your only source of income. You may also receive child support or other sources of aid or income. So list all of your income in the left-hand column and the amounts you receive each month in the right-hand column. If the amounts vary from month to month, try to determine an average for each source. Next, you'll need a record of your monthly expenditures, and this includes everything from housing to gas to entertainment expenses. Oftentimes, you can access this information by looking through your bank statements or receipts. And there are many free tools out there to help you document your spending. In fact, here at Neighborhood Credit Union, we have what's called a money management tool. And this is accessible for our members through the mobile app or our online banking platform. The Consumer Finance Protection Bureau also has an expense tracker on its website. And some computer software suites have spreadsheet templates that you can use. And there are free expense tracking apps that you can download and use on your mobile device. Finally, there's always good old-fashioned pen and paper, and we've provided one of these for you here in your participant guide on page 5. So you'll get a more accurate picture of your average monthly spending if you track your expenses for more than 1 month. Some months you spend more than others, especially during gift-giving holidays and while on vacation. So we've included space for you to track your expenses over 3 months and then average them in the right-hand column. Note that at the bottom of the expense tracker, we've included a space for you to record your total debts. The only debt that should be recorded on the expense tracker itself is your mortgage or your rent. You'll record all of your other debts on the next page on the debt section. So let's move over to that section now. So in the debt section, we ask for more information than just your debts and monthly payments. And this is because we know that knowing your annual percentage rate and balance can help you create a strategy for paying off your debts by taking into consideration the additional cost of interest on loans and other debts. We'll talk more about this later in the course. But for monthly payments, list what you usually pay each month for each debt. If the monthly payment varies, try to determine an average. Once you've listed all of your debts, add up the monthly payments and apply that figure to the debt section on the expense tracker. So please note that we've placed these worksheets for you in the participant guide for you to use, but it's important that the method of organization that you decide to use in the long term is one that suits you. It might look just like these, or you might prefer to go completely digital. Tracking your income, expenses, and debts is a great first step, but you can't stop there. In order to create an effective budget, you must analyze your spending. So once you've determined your total monthly income, your total debt, and your total monthly spending, you can calculate what's called discretionary income. Discretionary income is the amount left over after you deduct your expenses from your income. And figuring out your discretionary income shows you how much money you may be able to apply to your savings goals each month. So if you turn to page 6 in the participant guide and find the section titled Your Discretionary Income. To calculate your discretionary income, subtract your average monthly expenses, including your debts, that you recorded in section 2 of the expense tracker from your total income recorded in section 1. This is the amount you have left over every month. It's what you can afford to apply to your savings goals. Now, unfortunately, this number is typically much less than we'd like it to be. So, in order to increase that amount, we need to take a more analytical look at how we're spending our income. Have any of you heard of the 50-30-20 budgeting rule? Well, this rule is a commonly quoted financial rule of thumb. It says that you should split your expenses into 3 categories. 50% should go towards things you need to live, such as your rent, mortgage, groceries, and utilities. 30% can be spent on things you want, but don't necessarily need, such as eating out, shopping, and entertainment. 20% should be applied to savings and paying down debts. Paying down your debts does not include minimum payments. These are included in your needs because you need to pay the minimum amount so that you are not penalized. If you think about it, you'll see that this budgeting rule is fairly flexible. It allows you to put down nearly 1/3 of your income towards things that bring you enjoyment. So let's see how well you're following this rule. So if you turn to page 7 on the participant guide, find the section titled 50-30-20 Budgeting Rule. You'll record your net income at the top of this section, and you can take it from the previous section. Now, calculate how much of this income you should apply to each category based on the 50-30-20 rule and record them in the boxes on the chart. So now that you have an idea of a recommended budget, you can figure out how close you are to following it by analyzing your expenses. So if you go back to page 5 on the expense tracker, take a minute to label each of your expenses as a need or a want, and be honest. Some items can be tricky. You'll have to decide for yourself whether your gym membership or cable television is a need or a want. These labels are subjective and depend on your own identity and lifestyle. Okay, so once you've labeled your expenses, you can perform the calculations. And you may need a calculator for this one. So add up everything you spend on your needs and your wants, and then divide each of those two totals by your income. You can move the decimal point 2 places to the right or multiply that figure by 100 to get a percentage. You should now have a good idea of how well you're following the 50-30-20 budgeting rule. So now what do you do with this information? Well, if you're spending more than the recommended percentages in either category, you may need to rework how your funds are distributed. If you're spending too much on needs, consider options for downsizing. For example, maybe your rent is too high for your current income, or perhaps you're spending a lot on costly foods every month. Sometimes cutting from the needs category can be difficult, but oftentimes things we think are needs are actually fulfilling some wants as well. If you're spending too much on wants, maybe you're consuming too many afternoon lattes or taking too many weekend trips. Figuring out the spending habits that are preventing you from reaching your savings goal is really something that only you can do. So we'll wrap up this part of the course by doing another reflection. So this time, go through your expenses and really think about what you can do to free up some funds. Then record them in the table on page 8 of the participant guide in the section called Cutting Expenses. So we've been spending a lot of time looking at needs and wants. At this point, you may be wondering what happened to the savings category. So now I'm going to turn it over to Charlotte to talk to you about savings.
Hello, everyone. Hi, I'm Charlotte, and now we're going to carry on with savings. Now remember, 20% is recommended amount allocated towards the savings category. This includes paying off your debt. However, this is not a hard, fast rule. In fact, if your savings goals are ambitious, maybe you haven't been contributing to a retirement account and need to make up for lost time. Or maybe you have a lot of debt that's holding you back. You'll want to put more money or more than 20% in this category, which means you'll want to reduce your needs and wants even more. For the 20% in the savings category, you want to be strategic. The following recommendations may help you reduce your debt, which will help you free up some more money and to have more income faster, which will help you save more. Now, here are three recommendations. The first thing you want to do is start building savings for an emergency. Contributing to a retirement fund, especially if your employer matches your contributions. Paying off high interest rate debt, you want to do that. And let's discuss the importance of paying down your debt first. The importance of paying off your debt cannot be overstated. Now, some debt is more harmful than other debt. When you discuss paying off your debt, we're focused on high interest debt. Credit cards are usually the worst form of debt, but some loans can also have high interest rates. Why is paying off your debt or your high interest debt important? For a couple of very significant reasons. First, each month that you don't pay off your balances, you accrue interest. What does that mean? I'll give you an example. Let's say you charge $5,000 on your credit card with an interest rate of 15% APR. Your first interest payment may be around $60. $60 brings your balance to a total of $5,060. I know you're thinking, that's not so bad, right? Well, if you pay only $60 each month, your balance may never decrease. You'll owe $5,000 indefinitely because you'll only be paying off the interest every month. And you'll be paying your lender hundreds of thousands of dollars in interest payments every year. If your credit card uses compound interest and you don't pay the $60 the first month, it's even worse. The next month, instead of being charged interest on the original loan amount of $5,000, you'll be charged interest on the loan amount and the remaining interest. The point is that credit card debt is very costly. If you work to pay off these debts, you'll be able to apply what you use to spend each month towards your savings. So instead of paying for credit card debt, you'll be saving that money. Here's an example to highlight how this may work. Imagine a person with a very successful, lucrative career who wants to begin building wealth by buying their first home. Looking at their salary, you'll think that there would be no problem with saving for a down payment. They spend less than the 30% on wants every month. However, this person's problem is their debt. There is student loan debt, there's car payments and credit cards. And the spending over $1,000 on a month to cover old debt and debts, continuing to accrue interest every month on credit cards. There is not very much left over for savings. And there's not a lot of progress being made paying down debt. Therefore, it makes sense for this person to prioritize lowering debt payments as a goal before start savings for a down payment. There are two methods that this person can use to consider reducing its debt. There's the avalanche method and the snowball method. The avalanche method, you first focus on paying off the debt that has the highest interest rates. So in the example on the slide, which debt would you pay off first using the avalanche method? Remember, this is the one that has the highest interest rate. I know if you're thinking A, the major credit cards, then you're correct. A is correct, major credit cards. Now let's look at the snowball method. With the snowball method, you focus on paying off the debt that carries the lowest balance. So which debt would you pay off first in this example? Using the snowball method. Well, if you're thinking B, the retail credit cards, that's correct. You would pay off the retail credit cards. Both methods have advantages. The important thing is to stick to a strategy to pay down your debt so that you can begin freeing up more funds to put towards your savings goals. Speaking of savings goals, does anyone remember saving goals included in the setting your goals worksheet? What did we put in the section of setting your goals in the worksheet? Yes, building your emergency savings. We really need to focus on building your emergency savings. Let's take a moment to discuss the importance of creating emergency savings. How many of you have ever experienced a financial emergency? By that, I mean something unexpected happened that required a considerable sum of money. Emergencies happen. The roof starts leaking. We get involved in a car accident. We get sick. There's a death in the family. These things are all part of life. A report out of Duke University predicted that over half of all U.S. households will experience at least one financial shock, averaging $2,000 or more. Sometimes emergencies can be even more expensive. What if you lost your job? What do you do when you have an emergency that the money in your checking account is not enough? How do you cover your expenses when you don't have an income? Many of us end up using our credit cards in those situations. And as we just discussed in the last section, using your credit card to pay off or to pay for emergencies could lead to a downward spiral of debt. Because the more debt you accrue, the higher your monthly expenses and the less you can put towards your savings goal. To protect yourself from a spiral of debt, experts recommend maintaining emergency savings that covers 3 to 6 months of your living expenses. This probably sounds like a significant amount, and it may seem impossible right now. What's important is that you save something. Even $500 will help ease the burden in the event of an emergency. Let's go back to your goal sheet in your participants guide on page 5. And let's fill in a goal for your emergency savings. Look at the average total monthly expenses. Decide how many months you feel comfortable saving for and multiply that by the average total monthly expenses. Remember, some of these listed expenses are wants. In the event of a long-term emergency, you'd probably cut these expenses considerably. So your overall monthly expenses will be less. For this reason, you may decide to use only what you spend on needs for this calculation. Put this figure in the second column next to building emergency savings in the setting your goals table on page 3. Then decide how long you think you need to save this amount. Paying down your debt and creating an emergency savings is a great way to reduce your expenses so that you can free up funds for your savings goals. But there are many other strategies. Some involve changing your habits, and some involve changing your mindset. Let's go over a few of these strategies now. When freeing up funds, what do you think is the best place to start? Is it your wants or your needs? Is it that morning trip to the coffee shop? dining out, weekend entertainment. Those are all excellent places to free up funds. But the best place is one that many people don't even think about. When you really want to focus on freeing up funds, oftentimes the best place to look isn't your coffee bar or your coffee or bar habits. It's your bigger expenses, especially those in the needs category. The first place to look is your reoccurring expenses. It's those agreements you have and contracts you've signed, like for Netflix, Amazon Prime, Hulu, those type of contracts. And you might want to how ask yourself, how often am I watching them or am I using them? Is it worth the benefit? If any of these situations sounds like yours, you're not alone. Once we have a subscription or a policy, we have a tendency to become content and just stick with it because that's what we've been doing. Following the status quo is easy, but it's also expensive. Sometimes going through your reoccurring expenses can save you hundreds, maybe thousands of dollars a year. The second place to look is at your more costly purchase: cars, homes, television. How many of you shop around when buying a larger item? Most of us do. Most of us shop around. The problem isn't shopping around the problem isn't shopping around for the best deal. Not really. It's in making the right decision. Some experts claim that Americans are serial overspenders, oftentimes spending more than we can afford, especially for bigger ticket items. We buy too much house, or we get the latest version of our cell phone, even though the older version works just fine. I'm guilty of that. It's important to reward yourself, but we also need to realize when we're giving into our present bias, allowing short-term rewards to take precedence over more important long-term goals. It's time to do some self-reflection. Turn to page 9 in your participant's guide. Take a moment to think about the ways status quo bias and present bias have dictated your financial decisions, and try to come up with some new strategies you can implement to improve how you shop around or how to make purchases that follow your budget. Maybe you need to review your auto insurance policy. Or maybe you need to reconsider that new gaming system you were eyeing online, or that pair of shoes. Another possible strategy to free up funds involves increasing your pain, your spending pain, that is. You see, much of our spending is the result of convenience. It's easy to buy something, so we do. Some experts believe that if you make buying things more difficult, more painful, you may spend less. Open up your participant's guide to page 9 for this activity. Let's brainstorm some ways we can increase the pain of paying. And then we'll share we're not going to share our answers today, but if you want to write your answers in the chat, feel free to do so. I'll give you one to get started. This is purposely very painful. It's not one I really recommend, but it may help you jumpstart your thinking. Here it is. Instead of using dollar bills when shopping, use only coins to pay for your purchases. I know that would be quite painful to sit there and have to count all my coins up, but it is purposely meant to be very painful. Here's another one. You can use cash instead of using credit cards. Because sometimes when we're using our credit cards, we're just spending and spending and spending. But use cash. Avoid shopping online. No, that would be quite painful. And do not store payment or personal information online. Do not bookmark your shopping sites. Make it harder where you have to go and find your shopping sites. Don't just bookmark them where you can just go to them one click and you're there. No, no, no. Just make it hard where you have to put the whole web address in. The last strategy to free up funds is about finding the best deals. There are 5 different parts or tips to this strategy. The first tip may cause you to take up a new hobby. Yes, that new hobby is extreme couponing. If you remember on TLC back in 2011, 2012, there was a show called Extreme Couponing. I love that show. I watched it many times. And this is where people gather coupons and then they would go into the grocery store. They have about 3, 4 carts full of stuff. And then they'll get to the register, they ring it all up, and then they will use 1,000 coupons and they will end up having to pay like $6. Or sometimes they would walk out and they got change back. They never gave any money. So I love that. Here's some places to find. Well, how many of you have ever used a coupon in the past year? Or the past month or the past week? I mean, there are coupons for like Burger King. There's coupons where when you're buying something online, you get a $10 off, like Kohl's. So there are all different kinds of coupons. Those of you who aren't using coupons regularly are missing out on some awesome money saving opportunities. Where can you find coupons? You can look for websites devoted to couponing. Do a keyword search for a specific item. Like if you're looking for Tide, put in keyword Tide coupons. And then you can check your mail for coupons for local retailers. And if you're not into couponing, that's okay. There are 4 more tips that you can use to save money. The next tip is when you're shopping, don't forget to check the clearance aisle. The clearance aisle, these products on the clearance aisle are often just as good as all the other items in the store that's not on sale. Sometimes they're just off season. The clearance items can be marked down 50% or even 75%. Now that's a savings. Markdown sites. The same goes for discount or clearance websites. Oftentimes, the same products offered on retail sites are being offered on discount sites for much less. And buying in bulk is my favorite. Another strategy is purchasing items in bulk. When you buy in bulk, like at warehouse brick and mortar stores like Sam's Club, Costco, you pay more upfront, but the cost of a single item is much less than what you would pay if you was purchasing them individually. And get it when it's hot. The last tip requires changing your purchasing mindset. Most of us buy things when we need them. I run out of soap, so I head to the grocery store. My mom's birthday is coming up, so I start shopping online. This isn't how the best money savers shop. However, rather than buying things when they need them, savvy shoppers buy them when they're on sale. Maybe your anniversary is 3 months away, but you see a perfect gift at a reduced price today. Consider buying it if you have the extra income. Okay, now when following these tips, there are some important rules to consider. When shopping discount or clearance, be sure to check expiration days and carefully examine all items for defects and damages. Saving $10 on a steak isn't worthwhile if you risk food poisoning by doing so. Don't trust the first price that you see. If you're in the market for something you don't usually purchase, be sure to shop around. When purchasing items in bulk, make sure that you can use them in a timely manner, especially before they expire. And finally, don't be seduced into buying something you don't need just because it's a great price. Saving $10 on pet shampoo doesn't save you anything if you don't have a pet. These are the money saving tips that financial experts mostly common recommend. But I bet there are tips that many of you use that we haven't discussed today. So you might want to write your tips down. If you want to, you can put it. If you want to share, you can put them in the in the chat section of our meeting today. Just remember, your personal experiences could really help someone who's here today. So don't hold back. Okay, so if you'll turn your participants guide to page 10 on the freeing up funds. Okay, we discussed goal setting. You've started your personal budget. We've explored ways to free up funds. You've already done more in the last 45 minutes or so than people do in a lifetime. Unfortunately, planning is only half the battle. The real challenge is what comes next. The hard part is sticking to your budget and continuing to implement those money saving strategies. Just like any reward in life, it takes discipline and motivation. But there are also some life hacks that can help make this a little easier. This will be the focus of the last section of this course. There are four strategies we'll discuss, just like everything else in this course. Some of these strategies involve changing your mindset, while others involve changing your habits. The first strategy is a combination of mindset and habit. You see, experts in many different fields recognize that people respond much better to rewards than they do to punishment. When it comes to changing their behaviors, you may find that budgeting is less of a chore or a punishment if you provide yourself with a short term incentive for saving. Instead of putting all your discretionary income towards your medium term and your long term savings goals, use a percentage of it to treat yourself to something special each week or each month. For an example, like a nice dinner, an expensive bottle of wine, but not too expensive, and or a new video game. It is equally important that you don't feel ashamed or guilty if you slip up or unable to save as much as you hoped. Some months will be better than others. What's important is your long game. Strategy number 2, make it automatic. The second strategy again focuses on your tendency to avoid things that are too difficult. Just like we may spend less if it's more difficult to spend, we'll save less if it's difficult to save. So make it easy by making it automatic. Sign up to have a portion of your paycheck go into a designated savings account every month. Have your retirement contributions come directly out of your paycheck or checking account. Set up automatic bill paying. Once you've paid the balances on your credit cards, sign up for automatic payments. Pay off the entire balance each month. This will prevent you from ever owing interest. And you'll still earn points if your card has rewards. And create buckets. The third strategy I've already alluded to in strategy number 2. This one involves creating buckets for your savings goal. Research shows that it's more difficult to save for a specific goal if you're just using a checking account or even checking a savings account. Instead, create a specific account for each savings goal. If you're saving for vacation, create vacation. Create it, call it Puerto Rico Vacation Fund. Use a designated investment account for your retirement. Invest in products designed for a medium-term savings goal. Name your savings account for the goal they are being used for. And our last and final strategy. Finally, use technology to your advantage. Research mobile apps and online resources that can help you track your spending, manage your finances, and pay bills. There are even apps that remind you a bill is due or alert you when the funds are in your checking account are low. When you have time, you may consider setting up an appointment to meet with your financial institution representative to learn more about these services and products available to help you stick to your budget. Remember, the easier it is to budget, the more likely you will be to use it. Be sure to maximize all the tools and strategies at your disposal. We're here to help. There are a variety of tips and strategies to help you free up funds, stick to a budget, pick the ones that are best suited for your own needs and lifestyle. The most important thing to remember is that budgeting is not a punishment. With motivation and the right attitude, budgeting may bring you the reward of financial freedom. That concludes our webinar today. So thank you all for joining us.